Hello and welcome to the show. It is great to have you with us. Well, as the markets expected, the Federal Reserve cut rates by a quarter point today, the second cut for the year. But the Fed was somewhat divided when it comes to whether more cuts are coming later this year. Here to dissect the latest Fed decision is Scott Colbourne. He's Managing Director at TD Asset Management, joins me here in studio. Nice to see you.
Good to see you. Thanks.
Let's start with the what came out from the Fed today. We did get the rate cut.
Yep,
Again,
25 basis points.
widely expected.
Yep.
Take me through, when you're looking at this statement, what you parse, what you look at, and what's material to you.
Yeah, so 25 basis points, rate cut as expected. Some slight adjustments to their funding vehicles, their interest on excess reserves. So some tweaks to the plumbing, if you will, of the financing. The statement was largely the same as the last meeting. So, really the balance of the environment is really largely unchanged. So, Jay Powell really focused on external threats rather than internal issues in the U.S. as the balance of the reason for the cut. And
I think, I know you and I were speaking earlier too, that part of it was, he wants to say as much as he can with saying as little as possible to kind of leave the options open, which is a bit of a change from when he first came in.
Yeah, he's definitely stumbled a few times. Last time it was a mid-cycle adjustment, which left people feeling that, maybe two cuts and they're done, and that was a little bit too hawkish. So he really tried to steer clear and just keep as many options open as possible going forward.
How are you feeling about the outlook in terms of the economy and what the Fed is doing, and just, is this enough? Is it too much in terms of the rate cuts?
I think it makes sense. I mean, clearly the pivot at the beginning of this year, we saw the Fed tighten too much, and we are in part of this is unwinding this grand experiment called quantitative easing, and we've embarked on the tightening and the quantitative tightening and the tightening, and now we're seeing the implications of this. And so over tightened, now we're just sort of dialing it back a bit, and the Fed is really trying to be data dependent in each meeting, and we're trying to gauge the temperature, and then you throw in the external stuff, trade talks, trade tensions, and so. Really, it's a fine stepping stone between the external and the internal balance of the U.S.
Let me ask you one thing that comes out, of course, when they make the cut or make an announcement is you get the dot plot. And these are all the people, of course, who get to have a say in terms of what's happening with the rates. But the problem is all these dots are not created equal, and we don't know. I find the dot plot a bit of a mystery wrapped in an enigma.
Yeah.
So one thing we heard is that, two members are saying that no more rate cuts are going to be coming. 5 didn't want to do this one. That seems alarmist.
There's a lot of confusion, right? And many people argue it's past its effectiveness, right? Let's get rid of it. But if you look at the dot plots going forward for the balance of this year, you see 5 members of this 17 wanting to raise rates, 5 leaving them where they are, and 7 saying that we've got another cut. So you have to parse it. Are they voters, non-voters?
But you don't know that when you see
and
the
you
dice.
don't. But I think as you slice and dice, as market participants sort of guess, I think the balance leads towards expecting another cut through the end of this year. So it is a very confusing vehicle, and I think we could move on from it.
Let me ask you. Obviously the Fed today, they did make it. You mentioned they made a small tweak to the plumbing, as you talked about, in terms of the reserves.
Yep.
The rate that's available in the reserves. Can you back up and give us a little context? And I know this is an academic, wonky, conversation.
Yeah.
So, this is related to what happened in the repo market. Now, I'm going to say this to you, and you can tell me if I'm wrong. The repo market is a place where banks go for financing, to do overnight financing, very quick things.
It's the short-term vehicle. It's the overnight rate, one-day rate, and that has a ripple-on impact throughout the yield curve. And if there's stress at that point,
and there was
over the course of this week, we look and try to decipher: is this more technical, transitory, or is this more of a canary in the coal mine? Are we looking for something is broken?
Right.
And on the balance, I think it's technical. The Fed has tried to address it over the last 3 days of adding excess reserves to help banks and short-term, investment hedge funds predominantly to finance these investments. So they've tried to provide some liquidity and reduce the stress short-term rates were at about 10% briefly.
Yeah.
You know, and the Fed is a 2% target. So
that's bad.
A lot of stress.
Yeah.
And but again, this is part of the unwind of the quantitative tightening and quantitative easing and then tightening, and how many reserves are appropriate to finance the ongoing expansion of the balance sheet. And at the end of the day, Jay Powell did allude to the fact that the Fed's probably going to have to increase and let the balance sheet grow again, stop the quantitative tightening, in order to accommodate a natural growth of reserves. And some people are calling this QE light. I think honestly, it's just trying to find out what the appropriate level of reserves is for the system.
Okay. Last question for you. Based on what you've heard today, what is your prognostication for the level of the U.S. dollar? Where do you see it going?
Well, I think we're going into the end of the year. This sort of stress that we saw in the funding market.
Yep.
There's demand for U.S. dollars. As we go into the end of the year, it's been a good year for a number of asset classes. I know Trump and others have wanted a weaker dollar, but I think pretty much, there's going to be continued support. The Fed didn't come out really dovish today, and you have the ECB as very dovish. So a net, I think there's still going to be support for the U.S. dollar going into the year end. I
lied. I have one more last question. Sorry.
Okay.
Do you expect? I mean, we talk about negative interest rates, and we're seeing it in different parts of the world. Is that something that could ever happen in? I'm not going to ask about Canada because I want to say I don't think it's likely, but the States, could it happen?
I think you saw the regional banks have put out research that's really pushing back against negative interest rates. If we get to a situation where we need extraordinary policy, I think they'll extend QE in more innovative ways as opposed to going down the route of negative interest rates.
Scott, always a pleasure. Thanks so much.
Pleasure. Thank you.